As your tech, e-commerce or gaming business begins attracting customers in the US, one question almost always comes up. Do I need to worry about US taxes now? And usually that question quickly turns into a few more. Do I need to set up a US company? Which states do I have to pay tax in? And what if I'm only selling digital products? If this already feels confusing, you are definitely not alone. These are among the most common questions we hear from global businesses. So today, let's break them down simply and clearly. Big picture first. US taxes are not based on where your company is registered. They are based on where you actually operate your business. That connection is known as tax presence. This means that if your company has enough commercial activity in a US state, that state can apply its tax laws to you even if your company is incorporated overseas. The two taxes you'll typically run into when selling into the US are sales tax and income tax. Let's start with the first one, sales tax. This is a tax paid by your customer, but collected and remitted by your business. Sales tax is determined at the state and city level and usually ranges from around 6 to mostly 10%. It applies to physical goods, and in many states it also applies to digital products like SaaS, games, subscriptions or in-app purchases. The second type is income tax. This is a tax on your business profits. At the federal level, the corporate income tax rate is fixed at 21% under the prevailing rule. State-level income tax varies depending on where you operate. It's also important to know that even if you don't need to collect sales tax, you might still be subject to income tax obligations. The one concept that matters most and you should remember from this video is tax presence. Everything starts with tax presence, also known legally as Nexus. It means having enough connections to a US state that the state can require you to register, collect taxes and file returns. There are two common ways Nexus is established. The first one is physical activity. For example, if you have employees in a state, store inventory there or operate an office or warehouse, that can create tax presence. The second one is economic activity. In many states, if your annual sales exceed about $100,000 or you conduct roughly 200 transactions, that alone can trigger Nexus and with it tax filing requirements. Once either threshold is met, registration and compliance follow. You may argue, but I don't have a US company. This is another very common concern. And actually, you don't need a US company to start selling to the US customers and become subject to US taxes. And once local tax rules apply, you still need to register and file as a foreign business. Many international companies begin this way to test demand and validate the market before expanding further. Later on, when a US company makes sense as your business grows, a local entity can become practical. This is often the case when you need a US bank account, want to work with large domestic partners, plan to hire local employees, or are thinking about long-term business. Many global businesses start with a limited liability company and expand their structure later as the business matures. Why getting this right matters? US tax rules are very strict. Late filings or mistakes can lead to penalties, interest. Some platforms may even pause payouts if compliance issues are flagged. The good news is that most of these issues can be avoided with early planning and professional guidance. US tax compliance doesn't have to be overwhelming. Once you understand the fundamentals, you can plan proactively, minimize risk, and expand with confidence. At Anton, we help global businesses navigate expansion, payments, and compliance so taxes don't slow your business. Anton, think beyond payments, empowering your business to grow globally with confidence.